Today we're going to talk about journalizing dividends. That comes from chapter 14. In 14 we're going to talk a lot about distributing dividends, preparing a worksheet for a merchandising business. But before we get going, we want to talk a little bit about the terms that we have. The first term that we want to talk about is retained earnings. Retained earnings is an amount earned by a corporation and not yet distributed to stockholders. They can do one of two things with their earnings of business. They can either reinvest it or they can share it with their stockholders. If they decide to share it with their stockholders, that is what's called dividends. Dividends are earnings that are distributed to the stockholders. When they distribute the dividends, it can be one of multiple things actually. It can be cash or it could be stock. Businesses do not have to issue dividends, but if they do, it can either be cash or stock. Now, whether a business declares dividends or whether they keep the cash within the business, that's going to be done by the board of directors. And the board of directors is basically a group of individuals who are going to make the overall major decisions about a business. If the board of directors does believe that they should issue dividends to the shareholders, then basically what you're going to do is you're going to declare a dividend, and that's an action by the board of directors to distribute corporate earnings to stockholders. When we deal with dividends, it's pretty much the same thing that we've done before. Think of it, the easiest way to think of dividends is it is a more intensive drawing account. You're ultimately taking money from the owner's equity and decreasing the stockholders' equity of the business, and you are basically giving it to its shareholders. If you can think of that as a dividend, which means it's going to dividend as a drawing account, that means it's going to have it's a contra owner's equity account, which means it's going to have a debit account balance. That should simplify it. Dividends is a temporary account in that it is closed to retained earnings at the end of the fiscal period. When we get to that, when we get to that point later on, we'll talk about that. So let's take a look at a situation here. The board of directors, once again, they are the only ones that are going to be able to declare a dividend. They declared a dividend of $1.50 per share, and capital stock issue is 2,100 shares. Memorandum 258. Well, before we can do any transactions, we need to figure out a couple things. First of all, what is the number of shares outstanding? We need to times that by our dividend per share to be able to get our total dividend. In this case, we have 2,100 shares outstanding as it signified in the transaction. Our dividend per share is $1.50 per share as declared by the board of directors, and then our total dividend is ultimately going to be $3,150. So we now have figured out how much this dividend is going to ultimately cost us as the business or lessen our stockholders' equity. So now we need to basically record it. It's going to get recorded into the general journal, and we're going to use two different accounts. The first account, which we talked about before, is the dividends account. Remember, the dividend account, best way to explain it is it's a temporary account that gets closed to retained earnings. However, it is ultimately very similar to the drawing account as we used earlier in this year. It's going to have a normal balance of a debit, and it's like I said, it will decrease the stockholders' equity because ultimately we're taking cash from the business and writing and sharing that, or stock, and sharing it with the owners. Dividends payable is our next account, is obviously going to be there, and we're going to use the dividends payable. That's a liability, as we've done before many times, normal balance of a credit. And the reason it goes into dividends payable is we're setting that money aside until we pay it. Once we actually issue the check, that will be there will be a debit entry onto the dividends payable. But for right now, because we're just declaring it, now when you declare and when you pay are often two different times, you're going to see that it's going to be a credit balance for the payable. So our total dividends we said was $331.50. So we said we put it as a debit balance for dividends, and then our dividends payable, obviously a liability, it's going to be $31.50. If we move to the general journal, you'll see that we'll put our date, which we got up from the transaction. We'll do our account title. In this case, it's dividends. Is our first one, is our debit account title. We got the information from Memorandum 258, and it was a debit of $31.50. Now our debits, we have to enter the credit. We enter the credit account title, which is dividends payable. We're then going to enter $31.50, and we have successfully entered our our transaction of when the board declared a dividend of $1.50 per share. So now let's take a look now that we've declared it. Now what we're going to do is we are going to pay cash for it. Now paying cash is going to be a little bit different, but it's really nothing that we haven't done before. So if you remember from the previous slide, we had dividends payable. We said we had a credit balance of $31.50. Well, if we're going to pay cash, says right in the transaction, pay cash, our only other account that we can have is going to be cash. All right, so basically what we need to do is we need to zero out our dividends payable, and we need to ultimately pay cash. So what we're going to do is we're going to then put a $31.50 debit for dividends payable. That will give us a zero balance for the dividends payable account, and we'll do a $31.50 in our cash. Since we're paying cash, we're going to use the cash payments journal, and we'll enter the transaction as follows. January 15th, which we got from the transaction. Our dividends payable is our account title, which is our debit entry, which is our first one we enter, and we are going to put, and we're using check 721, and we're going to put a $31.50 there. Then finally, as we keep going on, we're going to use the special amount column cash credit, because we are ultimately writing a check to paying cash for this dividend that we're declaring to our shareholders, and it's going to be $31.50. So that's the difference, and pretty much what happens when you declare a dividend. Mind you, a couple things to keep in point is, number one, dividends is similar to a drawing account. Number two, declaring a dividend and paying cash for the dividend often happen on two different transactions, so make sure that you keep them separate. When you declare it, it's a dividends payable. When you pay it, you actually zero out the dividends payable. Thanks for listening, and if you have any questions, feel free to contact me at my Gmail account or via Twitter. Hope all goes well, and happy accounting.